Hi folks, this is Lee Jackson again on our continuing video series on insurance, and this is Do-It-Yourself Life. This is Indexed Universal Life. Now, we talked in our previous videos about life insurance that is good for a term of time. Now we're going to talk about insurance that not only is good forever, until you go bye-bye, until you die, but it gains cash value as it goes. Now think about this. If I put my money into CDs today, what's the rate? Under 1%. I mean, it's ridiculous. It's so low these days. But guess what? When you put it into life insurance, certain kinds have percentages that are amazing. There's one that I like that gives you 8% compounded interest, and you cannot lose. Did you hear that? In the old days you could. Today you can't lose. It can go up as high as 15%. It can go down to 0 per year if the market were to tank, but you can't lose. And it's currently running, for the last 30 years, the average is 8% compound interest, which means your money is going to grow like crazy. So what I normally do with people is I say, look, let's pull out a retirement calculator to see how much money do you have to put away for retirement. And when we look at it, generally, with most people, you have to put away so much money, like 50% of your salary, for example, and I can guide you to that calculator if you'd like. People say, I can't afford that. And I say, but what if you could do 1/10 of that? What if you could do just a part of that and put it away for retirement? That's what life insurance will accomplish. Most people think of life insurance when you die, and you know it does that too. But there's another part of life insurance where you grow value, and it's amazing how much it'll grow. So it's permanent. You can use it for retirement. You can use it for a loan that's tax-free. Your retirement would be tax-free. And there's always the death benefit, meaning when you pass away, somebody gets the death benefit, whatever it is. You can put in whatever you want, and you can change it later. It's very flexible. So the way I set it up is I'm a 35-year-old man, and I'm going to put in very low, $500 a month, very low. Now again, you can change it. You can put in less. You can put in more. You can tell it, I want to stop paying when I'm 65. You can tell it to start paying you back at whatever age you want. There's all different ways to structure it. So you can use it for college. You could live off the interest. Remember, tax-free. And you can cash out at any time. So I've run an example on my laptop next to me, which you're not going to see, but I'm going to read it to you because it's confusing, but I'm going to try to make it as simple as possible. So I'm 35 years old, I wish, healthy, and I'm going to put in $500 a month. So what does that get me? Let's take a look. Okay, this is something you're going to have for a long time. So you have to realize this is something you have to be comfortable paying. If you couldn't pay for a while, it will not die. But if you stop paying it, it will die at some point. So you have to continue. Now, if I were to put in $500 a month, and I'm 35 and I'm in pretty good health, my death benefit, which means if I die the next day, is $516,000, which is pretty good. But now I'm putting in money all the time. Now say I put in $500 a month for 10 years. In 10 years, I put in $60,000, and my value, if I cash it out, is $62,000. So if I get tired in 10 years, I haven't lost a dime. I get all my money back plus. So you always have an escape. And once the money is in what's called surrender value, that's your money. No one can touch it. You know, your stockbroker sometimes will call you up and say, oh, I got this great deal, I'm going to move your money. With this, you're the only one that can touch it. Now, I can't, nobody can, just you. So it accumulates value as we go. Now let's take another look. And if you'd like, all you have to do is send me your parameters, how old you are, male, female, your health, and how much you can afford to put in a month, and I'll send you this printout, email it to you, and you can look at it yourself and see what it does. And I'm telling you, you'll be blown away. It never fails when I sit down with people and show them what 8% compound interest will do over time. It's mind-blowing. Okay, so let's say now I'm 65 years old, I've had it for 30 years. I put in 30 years at $6,000 is $180,000. It's now worth $547,000, which means I could cash it out and get $547,000. My death benefit is $668,000 now, so that's going up. Everything's going up. Now I could take out some of that $500,000 and change as a tax-free loan, and I never have to pay it back if I don't want to. It just comes off the death benefit, which means say I take $20,000 out, it comes off my $668,000 when I pass away. So I really don't have to pay it back, and it's all tax-free. And one of the big questions I get is when you pass away and the money goes to your heirs, do they have to pay tax? The answer is no. There's no tax involved in any of this if you do it properly. Okay, so at 65 years old, I'm now making $53,000 a year in interest. So I could virtually live off that $53,000 a year in interest, tax-free if I wanted to. But if I keep paying in, it just grows and grows and grows. So now let's say I'm at 75 years old. Check this out. 75 years old, it's now worth, this is my money, $1,362,000. And the death benefit is $1,430,000. So when I die, somebody's going to get $1.4 million, and if I want to take money out, I got $1.3 million I can actually take out. Let's go a little further. You could stop at any time, by the way, but I just like to look at it because it's wild. Say I get to age 80 and I'm still only paying in $500 a month. I would have $2 million. That's my money I can take out. I can loan myself. The interest I'm making is $140,000 a year I could be living off of also. And you can also structure this so that you stop paying at any time. Say, I don't want to pay after 70 years old. Believe it or not, you'll have a lot of money built up, and it'll continue to build without you putting any more money in. It's amazing. And this is permanent. It never goes away. Someone's going to get the death benefit, which continues to grow also at some point. So let's say you're doing better one year and you want to put more money in than $500 a month, you can do that. Say you're doing worse one year and you can't put $500, you can do that too. Very flexible. And remember, these are backed by big, highly rated insurance companies that are not going anywhere, that have wonderful reviews, so that when something happens, if you need to cash out, you can get all the money immediately. If you want to take a loan against it, you can do that. If you want to pay for your kids' college or you want to live off the interest, you can do that too. And God forbid, if you do die, somebody will get the death benefit. So this is called Indexed Universal Life. And I think it's a wonderful way to put money away and have it grow. And you really don't have to put away that much, because 8% compound interest, which again could go up, is a lot of money. And it grows very quickly. So if you want to shoot me an email and tell me again how old you are, male, female, how's your health, how much can you afford to put in, I'll shoot you this back and you'll see it and you will be pleased. Thanks again. My name's Lee Jackson. If you want to ask me a question, I'm always available. I don't charge. And my number is 310-756-5976. Thanks again, and keep watching our video series. You'll learn a lot and be able to do-it-yourself insurance. Bye now.